Hello friends, we have seen silver soaring through the highs towards the later half of 2025 and 26 before crashing 30% in the end of January 2026. Why silver crashed? What were the reasons for it crashing? And what is the outlook we are looking at silver in the coming months? And what, as a high net worth individual, you as an investor have to consider while going for a silver? It will give you an actual perspective of how to approach this metal when you are looking for investments, because this will give you an insight into what are the different variables that play and that govern the trading of silver. Hello friends, this is Rajat, Dhar, managing partner at FinogentSolutions, your money sage. And today I will be unraveling the silver collapse and the way forward. We are actually looking at the reason and understanding the historic crash of around 31%. That is a single day collapse that has happened, and what is our outlook for the wealth preservation also and the way forward. So let us first look at the summary. First and foremost, it is a technical unwind that has happened and it is not a fundamental failure. So on January 30th, what actually happened was that the silver had lost around 31.4% of its value in a couple of hours, okay, erasing 7.4 trillion of the combined precious metals market value. Now, actually, this was much of a predictable sort of unwinding because there has been a speculative excess and there was not a collapse of a structural demand. So demand issues nahi the, it was only due to the speculation. So what is the context? The context has been an overextended rally which was driven by China's strategic export restrictions and a 5-year of supply. The second catalyst was President Trump's nomination of the monetary hawk called as the Kevin Warsh as the new Fed chair. And it actually caused the instantly the repricing, जिसको हम कहते हैं debasement trade happened. And the third reason being what actually increased the rate of fall for silver. This was an exchange margin requirements. They increased the margin that was required in the futures contract for silver as high as 50% in 1 week, forcing the liquidation cascade. Either they had to park 50% more as a margin or they had to liquidate. So many of the people, obviously they didn't have money because they didn't know how and where the silver will be headed. They actually went for liquidation. So what is the verdict? So while the paper market actually crashed, or paper market means futures, ETFs, the structural fundamentals actually remain intact. The physical positions provide protection where futures failed. Look at an event. So what is an anomaly? We're looking at 31% crash. So it was around January 30th, 2026. We have seen it hitting the peak and then falling. So if you see the value destruction, 7.4 trillion in combined metals. Historical context, if you see, it is the worst single day decline since March 1980. That means in 40 years. Then there is a gold correlation. It suffered the steepest decline since 2013. That is 9 to 12%. Why silver actually rallied to 121 in the first thing? First reason is China. China actually controls your 60 to 70% of the global refined silver with their impeccable infrastructure. So what they did, they said that, okay, all the exports are now to be done only by the government controlled, state approved 44 firms. They also reclassified silver as a strategic material along with rare earths. That means they will be curbing the supply. Now the issue is, when you see globally, supply is of 1.01 billion ounces. The demand, if you will see, is 1.24 billion ounces. The deficit that you are looking at is 230 million ounces. And there has been consecutive 5 years of deficits. There have been 5 years of deficit. Now on the back of it, now China also comes with controlling the export. It gives silver more tailwind because the supply is already less and then there are further restrictions. So demand is high, the price is soar. Then the second reason that came is the paper promises. What is the paper promises? Instead of buying silver, you are doing futures contract. If you're doing futures contract, the paper to physical ratio had been 356:1. So while the one contract of metal was followed by 356 futures contract. So now what it actually resulted into? It resulted into the cost to borrow physical metal actually hit the 8% annualized. Normally the cost of borrowing is only 0.3%. Now imagine you are having 0.3% as the cost to borrow and it has gone to 8%. So that is more than 10 times, more than 10, 15 times for that matter. Then there is an inventory drain. If you see 33.45 million ounces were withdrawn from COMEX in just 7 days, that is around mid of June. Then what is the conclusion out of it? The market was at tinderbox waiting for a spark, and that it happened. The third reason being, what was the catalyst? What actually exacerbated it? The trigger event was January 30, 2026. We were looking at President Trump nominating Kevin Warsh to succeed Jerome Powell as a Fed chief. Now his profile, if you would see that, why it reacted, his profile was being a monetary hawkish, not a dovish. He is skeptic of quantitative easing. He prioritizes inflation containment. He wanted to control inflation. That means opposite to what Trump had been actually doing. So therefore, what has been the impact? The debasement trade, that is betting on the lose money. The conclusion was that the market was a tinderbox which was waiting for a spark, and that spark was nothing else but a Kevin Warsh appointment as a Fed chief. Now, if you look at the 𝐻𝐞𝐫𝐞 of Evercore had mentioned that Warsh pick should help stabilize the dollar. Now the dollar and the silver, they are inversely proportional. The reaction was that the dollar resurgence happened and the yields also spiked. So therefore, if you see when the Jan 30, 2026 came, US dollar index, DXY, it gained up. It was the biggest single day gain since May 2025. And if you see silver, it was a single day fall that happened. Now, this also put one very good thing into perspective. That is the reason why you need to diversify. Many a times we tell investors not to put their all investment in the same basket. So suppose if you would have invested in NASDAQ, or dollar denominated investments for that matter, and you also had invested in, say, silver or gold or REITs for that matter, and REITs, REITs, and different assets in matter. So suppose if your silver has gone down, so you would have still averaged it against the dollar. So this is where actually the diversification, real example you can see happening in practicality. So what is the opportunity called? The yield surge, the 30-year treasury yields rose by around 5 basis points. The short-term yield for 10-year, they rose by around 2 basis points. The logic was silver yields are actually zero. So when the fixed income yield of 10-year, 30-year bonds yield rises, they know that we are going to gain having a capital gains, and also we are also getting a yield out of it. It makes precious metal less attractive, and the dollar is also strong, so money goes out it. And because the silver or precious metal, they don't yield any coupon on it. So therefore, when yields rise and also the dollar strengthens, the opportunity cost of holding a metal increases. It becomes more costly to hold a precious metal. Therefore, it triggers institutional exit. So institutions do not tend to hold any of the precious metal when they see that the cost to hold those things actually are increasing. So what is the accelerant? What led to it? Now, as the silver was also increasing and the China acted and then Warsh thing happened, the margin requirement was also going up in the meantime. So if we see that in CME margin requirements between December 25 to January 26, what happened? December 20, it was 13.6% margin requirement. Then it increased to 30%. So where the margin requirements were $25,000, it was $32,000. It increased to 50%. So this increase was within the week. Now, a standard, if you see the impact, the standard 5,000 ounce contract at $120 an ounce would mean a $6 lakh push, and the result is trader faced the immediate massive capital calls. They were getting a calls, either you fund it or you liquidate it. So most people actually chose to liquidate the things. It led to the cascading cycle in the silvers. The catalyst was the Warsh news, being appointment as a Fed chair, and the dollar spike. So this led to the algo reaction that high frequency funds, they started selling in milliseconds. The support levels, the price breaks the technical levels. When the support prices broke, the other softwares, other algorithms which were looking at stop losses, they started automatically sell orders on stop losses, triggering en masse selling trades. Now, when it happened, the margin calls were reached automatically. Aapke selling orders lag gaye, just put more capital at risk. So if you see the whole liquidation event, one thing led to the other and the whole thing went into a spiraling mode. And that is the reason why you are seeing around a 30% fall in the price of silver in a single day. So now what is the damage assessment as we see? If you look losers, they are primarily the paper and the leverage ones, because the leverage traders are forced to liquidate at lows like we have seen in futures. Crypto and tokenized silvers, we have seen 142 million liquidated in just 24 hours because these were cryptos and silvers entwined together. Retail ETF investors, they were trapped. SDIC silver fund suspended the trading. The fund itself suspended the trading. When you see the winners, they were the one who were having physical holders. Physical solid metal unke paas tha. There were no margin calls on them, no forced selling. So then there were the strategic buyers to it. The strategic buyers were like the Samsung CNT, which were actually going protected by logged in mining offtake contracts being involved in that. So what is the key takeaway? Key takeaway are the physical metal provides immunity to paper market dislocations, because then you tend to make benefit in a very short span of time. We are looking at the structural integrity. The bull case, the long-term buy logic still remains. Why? Because the China has export controls. It has become a law. It is not temporary. And the demand currently is less than supply. So we can see that the supply would not be meeting the demand. So therefore the price spike or spike up would still remain. Industrial demand, because of solar, EV and AI, will still remain at the consumption end. Thirdly, strategic mineral designation. It has been clubbed as a strategic mineral. So therefore, apart from China, others will also jump in to secure their access to silver and to have. So we can see more things coming up from different countries altogether, which might still be a push factor for silver. Now the correction flushed out the excess leverage. As we have told, a secular bullish trend for the silver remains intact. This is Ponmundi's our CEO of Enrich Money. So what are the lessons for a sophisticated investor? First and foremost, parabolic risk. This means that when an asset trades at 67% above its 200-day moving average, correction is mathematically inevitable. The second is, you as an investor have to also watch for the margins. Exchange keep on hiking the margin, and they are most reliable leading indicator of an imminent crash. So for example, if exchanges keep on increasing the margin requirement, that means with each increase in margin requirements, you have to shell out more and more money to hold the futures contract, which might not be possible when you are actually dealing in 5 crore, 10 crore, 1 crore, 100 crore at an institutional level positions in futures market for silver. So therefore, there will be people who will be actually liquidating their positions rather than putting more money. Seeing the trend of margin increase is also a way to see that pressure points are actually coming up. It might crash. Third is the macro trumps the micro. That means in the short term, Fed policy changes like Warsh overwhelm the supply demand fundamentals. So what the Trump did by appointment of Warsh has seen that how it had impacted and been that triggering factor, that reason the market needed for excess liquidity to be flushed out of the silver's market. And then the paper tiger. So you have 356:1 paper to physical silver ratio. It is a structural risk. It is a stress event. What we look at it is there has to be a position sizing. You have to maintain, any investor has to maintain 5 to 15% of the allocation. We tend to feel that, okay, let's put 30,000, 40%, 50% of the money in the silver. But then you should have the guts to bear the fall into the market and be responsible for that market fall. So therefore, you have to maintain strategically. If you ask from a portfolio point of view, it has to be 5 to 15% of the allocation. You have to build it strategically, and you don't have to chase the returns. If the market falls, you can still go and buy certain allocation into it. Vehicle selection. Prioritize physical like coins and bars over the futures and ETFs to eliminate the counterparty risk, because we have also been seeing where it goes into auction, there is a counterparty risk that still stands there. Third is the opportunity. Use the crash to accumulate your position. Violent corrections provides you the good entry points for that matter. Fourth is integration. View precious metals as a hedge within a wider wealth architecture. So go for these. This is a good inflation hedge. It is a part of your architecture, but that doesn't mean you go double down, triple down on single asset class. So therefore, friends, as we have seen in silver, why it corrected. And while as a novice investor, we tend to see, okay, silver had gone so much up, so the correction was imminent, but we don't understand the reasons that actually caused it. And this video of mine is actually structured to show you things are not easy and simple as they appear on the top of it. So every time, the next time silver gets corrected and you think about, okay, let me go and buy silver, you should be able to know what the news is at the back end, how things are happening up, and what actually causes the silver to go up or go down, and then take strategic measures. Thank you so much. This is Rajat Dhar signing off.